Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday everybody. Yesterday was a big episode. We did not have time to discuss the slew of new official data published on Monday. Today we will examine the salient numbers from this release, and as we will see, they are very disappointing. Indeed, the economic situation appears to be worsening, and this is likely reinforcing Beijing's decision last week to push ahead with major stimulus. Before we begin, for those interested in China's massive stock market rally of recent days, we discussed this at length in yesterday's video. The Manufacturing Purchasing Managers Index came in at 49.8 in September, up from August's 6-month low of 49.1, July's 49.4, and 49.5 in June and May, according to data released by the National Bureau of Statistics on Monday. However, as it was under 50, it is still in contraction. Meanwhile, the Caixin China General Manufacturing Purchasing Managers Index, PMI, which gives an independent snapshot of the sector, came in at 49.3, down 1.1 points from August, contracting at the fastest rate in 14 months. According to the official data, production rose the most in 5 months, coming in at 51.2, up from August's decline to 49.8. New orders grew to 49.9 from 48.9, ending a 5-month drop, while new export orders fell to 47.5 from 48.7. Business sentiment remained unchanged at 52. Bloomberg China economists Chang Shu and Eric Zhu observed on the numbers, quote, "The weakness in China's economy, evident in the September PMI data, shows why the government has swung into action to support growth, to sustain the boost to consumption, and kindle a genuine recovery. Implementation of the measures, particularly on the fiscal front, will be crucial." End quote. On the services side, activity grew at the slowest pace in a year, according to the non-official Caixin China General Services Business Activity Index. This index seeks to give a snapshot of operating conditions in industries such as retail and tourism, acting as a good proxy for consumption. It came in at 50.3 in September, down 1.3 points from the previous month. The survey showed that the expansion in supply and demand slowed in September. In contrast, growth in external demand shot up, with the corresponding gauge rising by nearly 2 points to reach the highest level in the third quarter. There was a mixed reaction to the optimism as the gauge for output expectations for the following 12 months sank to a 4.5-year low, according to the survey. Wang, the senior economist at Caixin Inside Group behind the index, expressed on these new data, quote, "Across the board, the latest macroeconomic data have fallen short of market expectations. Insufficient effective domestic demand remains a prominent issue, with significant pressure on employment and weak optimism constraining people's willingness and ability to spend." End quote. Yesterday we covered the property sector numbers too. According to preliminary data from China Real Estate Information Corp, the value of new home sales from the 100 biggest real estate companies fell about 37.7% from a year earlier to 251.7 billion yuan, $35.9 billion, faster than the 26.8% decline in August. Meanwhile, according to official data on Monday, China's external financial assets topped $9.8 trillion at the end of June, while external financial liabilities stood at over $6.8 trillion, resulting in nearly $3 trillion of net external assets. Next up, over the weekend, China's top diplomat Wang was in New York for a meeting of the UN General Assembly. He took the opportunity to meet with US Secretary of State Blinken. The meeting didn't appear to result in much new, except that the two countries agreed to, quote, "hold a new round of consultations on Asia-Pacific affairs in due course," end quote. According to the official U.S. Department of State readout, quote, "Secretary Blinken emphasized the importance of using diplomacy to responsibly manage competition, underscored the United States' continued concern with PRC support for Russia's defense industrial base and war of aggression against Ukraine, and made clear the need for the PRC to address Russia's threat to transatlantic security. He emphasized the importance of maintaining peace and stability across the Taiwan Strait and raised concerns about the PRC's dangerous and destabilizing actions in the South China Sea." End quote. Speaking of US-China relations, on Monday, Beijing slammed recent US military assistance to Taiwan, expressing, quote, US military assistance to the Taiwan region, regardless of the amount, will not sway in the slightest China's resolve to oppose Taiwan independence and safeguard national sovereignty and territorial integrity, end quote. A statement published on the White House website has announced the U.S. decision to provide military assistance to Taiwan worth around $567 million. Wang, while in New York, also delivered a speech to the UN General Assembly. Quote, I found Wang's discussion of how Chinese modernization, as articulated in the July 3rd plenum, set in motion a new journey where China joins hands with the world in common development and progress, interesting. Wang said that Chinese modernization will contribute robustly to world peace and stability, continue robustly to the common development of all, contribute robustly to improving global governance, and contribute robustly to the advancement of human civilization. Overall, his speech continues with the theme that the global order led by the US has failed most countries. End quote. This will be no surprise to regular viewers. We've been covering China's narrative battle with the West for some time, including its views on the current global order and its ambitions to shape it in its own image. Next up, once again, we look at China's massive market surge in recent days and ask how sustainable it is. But just quickly, if you're getting some value from today's episode of China Update, don't forget to hit the like button. Sharing and subscribing is a tremendous help too, and it means you'll be on top of the most up-to-date analysis on China as it's released. Patreon and Buy Me a Coffee links are also in the description for those who want to help keep the channel financially sustainable. Thank you so much. Chinese financial media outlet Caixin has once again published a special commentary from several authors warning that China's historic stock market rally in recent days should be viewed cautiously and in the correct context. Indeed, as we've discussed on China Update, the rally has been fueled by signals of stimulus from Beijing rather than actualized changes to the fundamentals of the economy. This new commentary published today by Chinese analysts and journalists is called Stimulus Drives China's Biggest Stock Surge Since 2008, but analysts fear it might fizzle out. To end today's video, we will examine some of the commentary, which we're now quoting selected excerpts from directly. China's A-share market has received the most immediate boost from a series of stimulus measures unveiled last week, but analysts are warning the boost may be short-lived, without further policies to solve the property crisis. On September 24, Shanghai Composite Index surged 2,863.13 points, when the heads of the central bank, the National Financial Regulatory Administration, and the China Securities Regulatory Commission announced the policy package at a joint State Council press conference, marking its best one-day performance since July 2020. The measures included new monetary policy tools designed to bolster the stock market, long-term capital inflows, and potential support for mergers and acquisitions. The momentum carried into the following day. On September 25th, A shares saw a trading volume exceeding 1 trillion yuan, $143 billion for the first time since May, with investors encouraged by both the policies and the promise of further economic support. On September 26th, China's Politburo, led by Chairman Xi Jinping, took the unusual step of tabling macroeconomic matters ahead of schedule, suggesting a heightened urgency to stabilize the economy. As investor optimism grew, foreign capital flooded into China's A shares, causing brief technical glitches on the Shanghai Stock Exchange due to the high demand. Even David Tepper, the prominent Wall Street investor, expressed optimism about the Chinese stock market, saying he would buy everything in China in an interview with CNBC. The CSI 300 index, which tracks the top 300 stocks on the Shanghai and Shenzhen exchanges, climbed more than 15% last week, the biggest weekly gain since 2008. The rally continued on the last day of September on Monday. Despite the excitement, experts warn the rally might fizzle out without significant improvements in China's underlying economic fundamentals, particularly in the real estate sector. Analysts from Goldman Sachs have warned that while the recent policies provide a short-term boost, lasting market growth will require deeper structural reforms and broader fiscal support. Pan Gongsheng, director of the People's Bank of China, announced a set of structural monetary policy tools on the September 24th press conference. These measures include a 500 billion yuan, $71.2 billion swap facility for securities, funds, and insurance companies, allowing them to obtain liquidity from the central bank by pledging assets such as bonds and stock exchange traded funds to invest in the stock market. While some analysts are optimistic about the expansion of the facility, others remain cautious, noting that brokerages and the insurance companies already have access to low-cost capital at a 2% interest rate. The real challenge lies in their willingness to invest rather than a lack of funding, a large brokerage said. Many analysts believe that unless the broader economic fundamentals improve, institutions will hesitate to fully utilize these tools. When China's CSI 300 index hit a 5-year low at the start of this year, calls grew for a government-backed stabilization fund to directly buy back stocks. After the September 24 press conference, when asked about the possibility, the People's Bank of China governor confirmed that it was under study. A stabilization fund, typically set up by the government through its securities regulator or finance ministry, aims to smooth out irrational market swings by operating in the secondary market. These funds have seen success in the past. In 1998, the Hong Kong government bought 118 billion Hong Kong dollars, $15 billion in stocks, stabilizing the financial market and defending the Hong Kong dollar and Hang Seng index against speculators, including George Soros. Other countries such as South Korea, Japan, and Taiwan have implemented similar measures. Analysts at Prosperity Securities Co. Limited say a stabilization fund could ease short-term market panic and boost trading, but caution that its long-term impact depends on the fund's size and market conditions. History shows that while such funds can provide a temporary lift, they don't guarantee sustained recovery. Caixin Securities Co. Limited analysts argue that the fund must be carefully structured, with mechanisms for entering and exiting the market to avoid moral risks, suggesting that buying broad-based ETFs rather than individual stocks would better preserve market integrity. Tao Chuan, an analyst at Suzhou Securities, stressed that the timing and scale of any intervention was crucial. Prolonged use of the fund, he warned, could distort the market and damage investor confidence. China's capital market continues to grapple with insufficient long-term funds and poor investment structures, preventing the formation of a strong long-term investment environment. Despite efforts to channel more long-term capital into the market, statistics show that as of the end of 2023, only 12% of insurance industry funds and 2.86% of banks' wealth management products were invested in equities. Insurance companies, seen as key players in long-term investments, have been slow to increase their equity exposure. Regulators have introduced reforms to encourage insurance funds to participate more actively in the stock market. One initiative is the creation of private equity funds to channel insurance capital into high-quality listed companies. A 50 billion yuan fund jointly set up late last year by the China Life Insurance Co. Limited and New China Life Insurance Co. Limited has invested more than 20 billion yuan in the stock market, Yang Yucheng, New China Life chairman, disclosed in July. Li Yunze, head of the NFRA, confirmed plans to expand the long-term investment reform of insurance funds, support other eligible insurers to set up private equity investment funds, and encourage financial companies and trust companies to issue more long-term equity products. Okay, that is the end of the direct quote and today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful Wednesday, and I will see you all tomorrow.